If you're holding any amount of XRP right now, even if it's just a small bag, you're going to want to pay very close attention to what I'm about to share with you today. Because the information I've gathered isn't just another set of recycled headlines or generic crypto updates. This is data that most retail investors don't even look at, let alone understand. Things like how longs and shorts are positioned in the XRP market, the liquidation heat map, and how all of this is about to collide with the current macroeconomic environment. When you put these puzzle pieces together, the picture that emerges suggests that the next few weeks and months for XRP could be anything but ordinary. Hey guys, welcome back to Whiteboard Crypto Update. In today's video, we will talk about XRP future. So be sure to stay focused, as you surely don't want to miss out on this. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads. Please remember this is not a financial advice video. Now, before we dive straight into liquidation levels and traders getting wiped out, let's take a step back and talk about the bigger forces shaping XRP's price in the medium term. Because what happens globally with governments and central banks doesn't just affect stock markets or commodities, it bleeds directly into the crypto world as well. Over the past year, I've been highlighting how economies across the United States, Europe, and Canada have been showing clear signs of stress. Just recently, Canada released shocking fiscal numbers, with its deficit ballooning to over $21 billion in the second quarter of 2025. To put that into perspective, this was a jump of nearly $20 billion compared to the previous period. And Canada isn't alone. Similar worrying signals are coming out of the US, China, and Europe. So what usually happens when governments face ballooning deficits and growth slows down? The answer is almost always the same. They resort to stimulus, which essentially means printing more money. And this is where things get very interesting. If you look at the M2 money supply, which measures the total amount of liquid money circulating in the economy, we're already at record highs. What's even more important is how M2 correlates with assets. Stocks, real estate, and yes, cryptocurrencies all move hand in hand with this expanding pool of money. The charts don't lie. As M2 rises, risk assets soar. It's almost a direct correlation. And here's the scary part. If you're sitting on cash, thinking that saving in fiat currency is the safe bet, you're actually positioning yourself on the losing side. Because not only will you miss the massive upside potential of investable assets, but your savings will also lose value in real terms as currencies are devalued. That's why investors worldwide are rushing into equities and digital assets. It's not just greed, it's survival. And XRP, being one of the most liquid and widely watched cryptocurrencies, stands right at the center of this. Now that we've set the macro backdrop, let's zoom back into what traders are actually doing with XRP. This is where the story becomes both fascinating and, frankly, predictable. Because while the data clearly points toward asset prices being pushed upward due to global monetary policies, retail traders are often doing the exact opposite of what the data suggests. Instead of buying and holding, many are piling into short positions, betting against XRP. When we analyze the long versus short ratios across different time frames, whether the last 24 hours, the last week, or even longer, the trend is consistent. On most major exchanges like Binance and OKX, there are significantly more shorts than longs. Billions of dollars are currently positioned against XRP. This tells us two things. One, retail sentiment is largely bearish. And two, a huge amount of money is sitting vulnerable to liquidation if prices move against those shorts. And that's where the liquidation heat map comes into play. Looking at the heat map for XRP, one thing jumps out immediately. There are massive clusters of liquidation levels sitting just above the current price range. We're talking hundreds of millions of dollars that would get wiped out if XRP pushes up into the 28.7 to 292 range. On the flip side, the downside doesn't show nearly the same magnitude of potential liquidations for long positions. So why is there such a difference? The answer lies in trading behavior. Retail traders, the small players, tend to chase quick profits with high leverage. You'll often see them using 10x, 20x, or even 50x leverage. That means even a small move against them can completely wipe out their position. Institutions, on the other hand, don't play this dangerous game. They have billions in capital and can afford to wait patiently. They study the same heat maps we're looking at right now and realize that by pushing the price up just a few cents, they can trigger a cascade of liquidations that transfer billions of dollars straight from retail pockets to their balance sheets. We've seen this movie before. A sudden spike, a massive wick to the upside, and thousands of short traders wiped out in seconds. Then, after the dust settles, institutions can sell into the newly inflated prices, locking in profits while retail is left scratching their heads, wondering what just happened. That's why I keep saying, following crowd sentiment without understanding the underlying data is one of the quickest ways to get destroyed in these markets. And this isn't just happening with XRP. The same setup is currently visible in Bitcoin and Ethereum as well. More shorts than longs, heavily leveraged retail traders, and big liquidation clusters sitting right above current prices. The stage is set for an explosive move. Now, could we dip a little lower before that happens? Of course, crypto never moves in a straight line, and sideways trading is a normal part of the cycle. But when you combine the macro backdrop of endless money printing with the micro view of how traders are positioned, the conclusion becomes clearer and clearer. The probability of a short squeeze is rising fast. As for timing, weekends tend to be slower in crypto. Volumes dry up and the market drifts sideways. But once we move into the new trading week, I expect volatility to return in a big way. The amount of liquidity sitting on the table is simply too tempting for institutions to ignore. And when those liquidations get triggered, things can escalate quickly. XRP could spike hard, wiping out over-leveraged shorts and catching many traders completely off guard. So here's the takeaway. Don't let surface-level narratives blind you to what's really going on. Look at the money supply, look at how governments are behaving, and then look at how traders are positioning themselves. The data paints a story that is far more bullish than what most retail traders currently believe. If history repeats itself, and it often does in these markets, the next leg up for XRP could be one of those moments people look back on and say, I wish I'd been ready for that. Well, guys, that's all we have for you today. What are your thoughts on XRP? Get involved and let us know in the comments down below. Thank you.